Hi, everyone. Welcome to today's GRI Pension Seminar webinar. I'm Victoria Guo, the Director of Research at GRI. I'm pleased to welcome you all to our discussion today with three distinguished panel speakers on discussing the role of robo-advisors on improving pension income for Canadian pension participants. And so I'm pleased to introduce all the three distinguished speakers for today's event. Our first speaker, who's going to present shortly, Professor John Turner. John is the director of Pension Policy Center. He has published 14 books and more than 100 articles on pension and retirement income policy and financial advice relating to retirement. John has received many different research awards in his careers, with some highlights including the Best Article of the Year in the Journal of Risk and Insurance, Society of Actuary Paper Award, the Best Paper Award from the International Actuarial Association. John has received more than 3,100 professional citations. Well, actually, I checked this morning. That number has surpassed 3,600 as of this morning. And John holds a PhD in economics from the University of Chicago. We are honored to have Jillian and Kennedy and Nauvzer Badul also joining us for the panel discussion after John's presentation. Please allow me to introduce the two panel speakers as well. So Jillian is a partner in Mercer's wealth business, and she's responsible for leading the defined contribution and financial wellness strategy for Canada. Jillian is also a member of the wealth leadership team and works closely with Mercer's global teams. Jillian's main practice area is in supporting defined contribution pension plan and savings plans for plan sponsors and plan members. From plan design, investment, service provider management, and ongoing government support, Jillian applies a holistic approach to proactively manage plan sponsor objectives and improve the overall financial wellness of employees. And last but not least, Nauvzer Badul, our third speaker, is the founder and chief executive officer at Smart Money Capital Management Inc. Mr. Badul has over 16 years of capital market experience in various structuring, derivatives, and portfolio management roles. Before starting Smart Money in 2014, Mr. Badul held progressively senior positions at BMO Capital Markets, where he worked since 1999. He plays a key role in developing an equity and fixed income structured products business at BMO Capital Markets, with business being generated through Canada, the US, and Europe. And now please join me in welcoming our speaker, John Turner, to present his recent work, Robo-Advisor for Canadian pension participants. Over to you, John.
Well, thank you, Victoria. The presentation today is a project which I co-authored with Denis Latulip, who is a professor at Laval University. Next slide, please. I would like to thank the Global Risk Institute and National Pension Hub for inviting me to speak today, and also for financing this research. Next slide, please. So in this presentation, I will be talking about robo-advisors. I'm sure everybody knows, but I will say, in any case, robo, of course, is short for robot. Robo-advisors are a relatively recent development in financial technology, or what we call fintech. They are automated online services that use computer programs or algorithms to select and manage clients' investment portfolios. And often people have an image of a robot, and the way I describe it is that robo-advisors have the brains of a robot, but not the body. Next slide, please. So I'm going to be talking about Canadian robo-advisors. Robo-advisors we also have in the United States and other countries. The first robo-advisors in Canada were Wealthsimple and Wealth Bar, and they started in 2014. So it's been 9 years that there have been robo-advisors in Canada, which is a relatively short period of time. The original robo-advisors were new companies focusing on robo-advice, but subsequently established financial service companies have added robo-advisor services. Over this period of time, from starting at zero, I would say Canadian robo-advisors have grown rapidly. At the end of 2020, they had more than $11.4 billion in assets under management. Next slide. So what is the need for robo-advisors? A 2020 survey of Canadians found that 71% are not using a human financial advisor. So most Canadians, and it's true in the United States also, do not have advice from a human advisor. Robo-advisors provide low-fee investing advice, and this is important even to clients with small accounts. Human advisors generally would not help clients with small accounts. And so those people are effectively excluded from receiving financial advice. Some robo-advisors, and Wealthsimple, I believe, is one, have no minimum account balances. To use a robo-advisor, a client will fill out a questionnaire online, which asks about the person's age, their expected retirement date probably, the reasons why they're saving, how they feel about risk. In other words, how would they feel if they lost a certain amount of money? And it takes this information and determines what it considers to be the best investment portfolio for the client, and then it will manage that portfolio. Next slide. Okay. An advantage robo-advisors have over target date funds, which is an alternative approach, is that they provide portfolios that are suitable for the client's level of risk aversion, not just the client's age. So target date funds, as we know, is based on the date that you expect to retire, which is closely tied to your age, but there's no adjustment in that group for differences in risk aversion. Robo-advisors could eventually replace target date funds for many pension participants. And I'm not familiar, in Canada, but in the United States, target date funds are a very important aspect of the investments of individuals in their defined contribution plans. Next slide. There's been a lot of work about financial literacy in Canada, the United States, and most countries. Most people do not know how to manage investments. They do not have the advanced level of financial literacy that is needed to construct a low-fee, diversified portfolio that will be suitable for their level of risk aversion. One approach that deals with some of those issues is target date funds, but robo-advisors take it on directly. And robo-advisors reduce the need for financial literacy at the level of managing your pension investments. Next slide. So the investments of robo-advisors. Robo-investments typically include low-cost index mutual funds and exchange-traded funds. So they're not buying individual stocks, they're buying well-diversified and low-cost funds. Investors who use Wealthsimple have some optional portfolios, which include socially responsible investing, also called environmental, social, and governance. Next slide, please. An important aspect of robo-advisors is their fees. Robo-advisors generally charge fees in 2 or 3 different levels based on the amount invested by the participants and the level of services provided by the robo-advisor. At the basic level of service, robo-advisors typically charge substantially less than human advisors. Canadian robo-advisors generally charge roughly 40 basis points, some a little bit more and some a little bit less. Next slide. COVID-19. With COVID-19 causing more people to do online transactions to avoid in-person contacts, robo-advisors generally have increased in popularity. For example, Wealthsimple, the leading robo-advisor in Canada, reports it had twice as many new clients during March 2020, which was the start of the pandemic, than in March 2019, before the pandemic. Next slide. Wealthsimple is the largest robo-advisor in Canada. As of 2020, the most recent data I could find, it had 230 employees, and it's more than 175,000 clients globally. Actually, it's substantially more than that. And I think that's data that in 2021, it had a market value of $5 billion, making it one of Canada's most valuable privately held companies. Next slide. So I'm a big fan of robo-advisors. I think that they have advantages over human advisors in their fees. They're less likely to be affected by conflicts of interest. They are less likely to have the potential for biases against clients by their age, gender, race, or whatever bias that might affect some advice. In this section, though, I'm going to talk about ways I think that robo-advisors can be made even better. One basic way for robo-advisors to be made better is for them to have more information about their clients. And one way they could do that is if robo-advisors also provided tax preparation software. So they would have detailed information about the finances of the clients, much more so than they currently have. And they can link that information to the robo-advisor software in order to provide a better understanding of the person's finances when making portfolio decisions. Robo-advisors connected with employer-provided individual account plans could, and I'm sure do, use the data that employers have about their employees, such as age, income, sick leave usage, and family status to provide more personalized recommendations. Next slide. Robo-advisors differ in the advice that they provide. It's the same in the United States as it is in Canada, and it's also the same for human advisors in both countries. Steps could be taken to make it easier for people to compare robo-advisors. For example, it could be required that robo-advisors provide a standardized risk measure for their portfolios, say as for a person age 40, average income and average risk aversion. So it'd be possible to tell if you were getting into a robo-advisor that was taking more risk than more robo-advisors or was more conservative than most robo-advisors. Next slide. A general problem with defined contribution plans is how to disperse the money to participants in retirement. Do a good job of managing the money up to retirement, but when you get to retirement, it's up to the clients to figure out what to do. And so I'm going to suggest two different possibilities. Both of them I think are worth considering. Robo-tontines. Tontines are financial products which is like an annuity, with the major difference that the pool of participants bears the entire risk. It bears the mortality risk and it bears the financial market risk. It's a product that's been around for a long time and built out of popularity for a while. is making a resurgence, but still not widely used. So one innovative approach could be for robo-advisors to offer tontines. They already have people who are looking for a way to deal with retirement risks. And so they could create a tontine with the clients that they have and provide this as an additional service during the payout phase. The payouts are not guaranteed like an annuity. They depend on the investment mortality experience of the plan, but tontines are less expensive than an annuity because the tontine provider, or robo-advisor in this case, is not insuring the benefit. Next slide. An alternative and more traditional approach is that as clients approach their expected retirement age, the robo-advisor could start including units of deferred annuities in their clients' portfolios. So they would be buying annuities in small amounts, averaged over time, and when the person received retirement, they could then convert their deferred annuities into an annuity benefit. This could be done at retirement or something. Another option is it could be a longevity insurance annuity. So the person would postpone the start of the payments to an advanced age, such as age 82. Next slide. Work on pensions and other aspects have shown that defaults can be very significant in how they affect the outcomes for participants. And so one option would be, I'll just say as an example, in the United States, target date funds are very often the default fund. If a person is not sure what to do, they'll be placed in the target date fund. And that's accepted by many participants as a recommendation. Similarly, robo-advisors could be the default for pension participants. They would be, they could invest however they wanted, but if they weren't sure what to do, they could take this as a default. So I had a limited amount of time. I wanted to make sure I did not overuse my time. So these are the conclusions. So robo-advisors provide affordable financial advice to pension participants, which is particularly important for small investors who were effectively excluded from receiving advice at a small size of their accounts. They reduce the need for the advanced financial literacy required to construct a low-fee, well-diversified portfolio appropriate for the person's degree of risk aversion. Most people just are not able to do that. And in the paper, in my talk and in the paper, I have suggested options for making them even better. Next slide, please. This is the last slide. If anybody wishes to contact me, this is my contact information. So thank you very much. I look forward to the comments.
Thank you, John, for walking us through some key findings in your recent publication. Thanks again. And now we would like to invite Jillian and Nauvzer to join us for the panel discussion. And as a reminder, if you submit your questions throughout the chat box, I'll be monitoring all throughout our panel discussion and try to get them answered as many as possible. I would like to start first. Why don't we start with like a quick warm-up question to you all so that our audience can get to know better personally. Do you use any robo-advisor service now, any automated investment service, or some people call it light advice service? And if so, do you still remember in what occasion you kind of first started using them? Was it because, low fees and some convenience you're looking for, or just, simply out of curiosity, try them out? Maybe I'll direct that question to Nauvzer, since I know you have your own smart money startup company. Well, now it's not a startup, it's been 7 years. So perhaps a tricky question for you. Do you use any robo-advisor service at the moment?
Yeah, actually, it's not that tricky. The answer is yes. I use it for everything we do. For me, my family, my kids, we all use Robo-Advice for our financial advice.
Did you start it because you want some convenient robo like advisor service, or is it because the low fee attracting you, or what kind of got you started, if I may ask?
Yeah, it's funny because I know that when we think of robo-advice, we think of maybe smaller accounts or smaller net worth, but I don't think that's necessarily the case. I mean, in many cases, including ourselves, we have a very diversified portfolio, a series of portfolios from anywhere from basic ETF portfolios to more sophisticated portfolios that include actually privates and alternatives. So from a portfolio management investment product, I think it serves our needs better than you could find through a traditional financial advisor. Now, not to say there's anything wrong with traditional financial advice, but in our case, I find that the strategies that we employ for our clients serve my own purposes quite well. And many times I use myself as a benchmark or a sounding board for strategies that we want to employ.
Awesome. Thank you, Nauvzer. How about you, Jillian?
So I have to say that I absolutely have an account, but I have to say it's not my primary account. And the reason I have it is because it's just such an interesting area of development within the Canadian market. And I find it really super engaging and kind of fun. So I'll use it for short-term savings, but it wouldn't be my primary source of advice.
Jillian, I have to say I'm on the same side of the coin with you. Just out of curiosity, tried it out, and then
it's fun. I love the features. Yeah.
Exactly. Yeah. John, last over to you. Do you use? You mentioned Wealthsimple in your presentation just now. Do you use something like that?
I'm a big fan of robo-advisors, and I have been somewhat critical of human advisors in my own research. And I thought about using it as Jillian did, just to see how it worked. But I actually haven't done that. I'm trying to simplify my finances now. I haven't done that.
Yeah, sometimes, having an additional tool or application make your, in your decisions more complicated than you want it to be. And that kind of leads us to the next question. I know all of you three have intensive experience in the robo-advisor services and with different specialties in different areas. Perhaps could you take us through some key milestones of the robo-advisory services that you observed in the Canadian market? Maybe this time we start with John, because you cover many details in your presentation. Perhaps let's just take a 10,000 feet view, just on a high level. How has the role of robo-advisor has changed in Canada so far?
Probably Canadians will have a better answer than mine, but
Yeah,
okay, I'll direct to Jillian and then probably come back to you on the US side.
Sounds good.
Yeah.
So I'm focusing more on the kind of group retirement space. And so I'm going to start our kind of milestone journey with the year 2000. Because the 90s was a significant period of time where we saw more of a shift away from defined benefit pension programs that were pretty much a staple in the workplace towards, pensions, RSPs, more defined contribution type programs. And with that shift, we saw more and more employers saying, okay, I'm shifting the risk away from the employer to the employee, and I need to engage people. I need to give them tools to be able to select funds. So that really started in the year 2000. Now, interestingly enough, we really didn't have any type of guidance in any significant way in defined contribution plans or kind of group like workplace plans until about 2004. Right. So there was a period of time between 2000 and 2004 where it really was the providers, the service providers that were administering the investments and providing the tools and administering the workplace programs on behalf of fiduciaries that was driving some of the innovation. And today even, we only have about, I would say about 15% of assets under management in all of the Canadian workplace programs in non-defined benefit programs. right? So a lot of the assets are still sitting in these defined benefit pensions, but new money's going in, right? So that just gives you a sense on the immaturity of the market. So insurance companies came into the picture around the year 2000. Of course, they were there before, but in a big way, and said, we can solve the problem. We can engage employees. We can help them with investment selection. We're going to take a page out of the retail handbook that exists on many wealth management platforms. There were insurance companies have always been a distributor of investment product. And we're going to create, and by the way, this still exists today in Canada, we're going to create a way for employees to pick funds, which is a three-tiered structure. That three-tiered structure consists of asking the investor if they have the desire, the time, and the knowledge. And depending on the answer to those questions, pushing them into the direction of, I don't want to do anything. I'm going to completely outsource this decision to a manager. I do want to be involved, or I have an advisor and I want to completely build my own portfolio. And if they were in those last two categories, they actually went through the process of using the insurance company technology to go through a series of questions that was modeled from the Know Your Client experience in the retail market. And they were provided with an asset allocation portfolio. And so that actually was the start of the DC marketplace in Canada. And to this day, some of those tools exist. But we did see target date funds enter the Canadian market in 2009. And when that happened, we saw a pretty major shift away from these types of tools, because that first tier, if I, remember, it's I don't have any time, I want to outsource the decision, or I have time, that first tier became overwhelmingly more common. We even saw plan sponsors starting to actually encourage employees to go into default so that they could actually have a simplified enrollment process and just get them in and focusing on participation. And so today, I did look this up, only about 10 to 15% of employees are using these types of tools. And the majority of employees are actually skipping all tools and just defaulting into, something that is actually associated with their time horizon and not their risk profile. So that's a really quick update on what's happening in the workplace.
Thank you so much, Jillian. How about you, Nauvzer? From your experience, I know you have worked in capital markets and now you have your own company, Smart Money. So what's your observations and insights so far?
Yeah, it's as John said, Robo-Advice has only been available in Canada since 2014. So relative to other markets in the world, it's fairly new. But against that, I would say that we've gone through a fairly rapid evolution of the business model over that short period of time of 7 years. When Robo-Advice first came out in Canada, I think there was probably between half a dozen to a dozen participants, including us. We were one of the original, which John didn't mention, but I won't hold that against him. So there was about half a dozen to a dozen robo-advisors that were launched in Canada. And I would say that mostly all of us had the same goal, which was to penetrate the financial advice market in Canada and take business away from traditional advisors. But what we've seen since then is actually threefold. One is there are still a few participants that are still pursuing that strategy, like the Wealthsimples of the world, that are really trying to navigate clients away from traditional advice. But then we've also seen some acquisitions of some of those robo-advisors through some of the big FIs. And the third component is where I would put Smart Money is complementary robo-advisors. And by complementary, I mean, rather than trying to compete with traditional advisors or FIs or banks, we've tried to find ways of helping traditional advice. So whether it's working with advisors on some sort of referral program, or helping companies with our group savings program, or even just leveraging our technology into banks. So we've opted for more of a, as I said, a complementary relationship. And we're not the only ones, but as over time we've seen that we're all trying to find our niche in the marketplace. And so for us, it's been more on a complementary basis versus say Wealthsimple, who's really tried to go about it on their own. Now, in saying that, they are very well funded, which they need to be to pursue that business model, and they've done well for the marketplace.
Thank you, Nauvzer. And before I come back to you on the US side, there's a question coming in, and I thought that's quite related to what Nauvzer and Jillian has said. The question is, how do you think that Robo-Advisor will change the competitive environment for large investment companies versus fintech startups? So our audience is wondering, how's the role of Robo-Advisors going to challenge large investment companies versus the fintech startups in different ways?
So in the United States, what has happened is that all the robo-advisors initially were startup companies. It's a very innovative change to provide robo-advice at the retail level. It had been provided to financial advisors earlier than that. But what has happened is that the major companies like Vanguard and T. Rowe Price, they now have their own robo-advisors. So what has happened is that the idea has been it's been accepted by the major traditional players, and they've entered that market.
Thank you, John. Now, Sir Jillian, any thoughts to add?
Yeah, you know what? So I think, for the first couple of years that Robo-Advice was in Canada, it was much about proving that they're a viable alternative to traditional advice. And I think the days of asking those questions are behind us. We've realized that it is a viable alternative. And what it's caused is the big FIs to reevaluate how they treat their clients or how they work with their clients. It's the barriers to open an account are no longer as onerous as they used to be, and so for FIs, they've had to reevaluate how they've provided services in the past, whether it's onboarding, whether it's transparency, whether it's risk assessment, and improve their offering to stay competitive against the fintech market. Because what we've realized is that since robo-advice is a viable alternative, for those FIs that continue to do things the way they've always done, they do it at the risk of losing those clients. So that they've had to reevaluate how they provide the services that they have in the past and improve their game.
And I would add that one very relevant piece of information for the Canadian market is just how it's structured. So I mentioned about insurance companies and how insurance companies have dominated. They continue to dominate. They manage probably around 90% of workplace program assets that are considered to be defined contribution or savings plans. But the reason that has been attractive and they've grown so much is because they can offer institutional product. So investment managers that typically would have a $50 million minimum or only work with qualified financial institutional assets, or have some type of a designation that qualifies them for these institutional type investing. And so that's been tremendously fantastic for workplace programs. They get extremely low fees. They get access to very high quality investment product that an individual walking off the street could not invest in. However, what it's done is it's defragmented our marketplace, because as an individual, I go to my bank or I'm managing my own personal money differently. It's the first time I open a savings account, my mortgage, saving for my child's education. And so the list goes on and on. But the moments that matter in my life, I'm managing personal assets outside of my workplace program, which actually I probably depend on quite a lot to make sure that I can retire when I want to. And so different regulation, different ways of treatment, different investment product, and surprisingly, that institutional workplace actually has lower fees than retail. In fact, they can match and sometimes are even lower than robo-advisors. And so now if you put yourself into the position of an everyday person, how do you bring these things together? Especially if you have multiple jobs or if you have a defined benefit program that you don't understand as well, right? Like, how do you do that? And so I think, it's okay to be separate, but when people get to the point of moving into retirement, the consolidation has to happen somewhere, right? So the race is on to, see who will be able to gain these assets as people transfer wealth from one generation to the next.
And love your comments. And that's actually a perfect segue to our next topic. I want to direct our conversation and talk a bit about the role of robo-advisor and when it comes to longevity risk and changing nature of labor income, as you mentioned. And this is what many pension plans are facing. And it would be great to hear thoughts from all of you. Economies here with a fast growing of gig workers, as Jillian just mentioned, who make livings maybe most of the time outside the traditional standard income living activities. And how does this robo-advisor or automated investment service ensure that the gig employees have enough or adequate retirement income? Jillian, maybe would you like to share your thoughts first?
Yeah, I mean, I think that this is a major, a major issue, right? And I think we look at it from the perspective of, first of all, how do you actually engage a person in saving for retirement, when they're 45, right? That in itself is actually quite challenging. And I think that that's where Robo-Advice has done its job. And we see a lot of positive effects from people becoming a little bit more engaged. I mean, I started off telling you I have an account because it's fun, right? So if you can make planning for retirement fun, that's what people want. But at the same time, the challenge is going to be, how are we marrying together some really important things that are happening in the institutional marketplace where, pension plans are thinking about how do we all, come together to have even lower fees and start to share assets for retirees. Things like, DC type collectives will likely be introduced into our marketplace in the near future that would allow an employer to actually keep a retiree in their pension plan along with actives, or potentially join up with other pension plans to create one solution. And John, I found your comment on tontines very interesting, and I think that could be a very innovative way that robo-advisors could go, but that would require a complete and total restructure of the fund itself. Because today on the pension side, you're in an ideal situation where most investment products accessed through a wrapper that in turn invests in multiple different pooled funds. Whereas on the robo-advice side, it tends to be a little bit more of investing in actual securities that are being brought together through the technology itself. So the pooling effect needs to start at the fund level, and that would require quite a lot of overhaul of the operational structure itself. But I do think that is a very interesting comment, because I think, we'll see, how that evolves, but it will likely be something, that the institutional market will get to first. But definitely interesting thoughts on the whole kind of collective piece.
I'll jump in here. So, I think when we think about robo-advice, we think of a simple KYC risk assessment where we're really defining time horizon. And based on the time horizon, we're picking a portfolio to match that time horizon based on your risk assessment. The thing that robo-advisors have that aren't often recognized is that we have a lot more tools than just a simple KYC or risk assessment framework. In our case, as I mentioned, we have a group savings plan where the way we go about assessing or building a portfolio is starting with the goal and defining what that goal is. So in the case of a retirement, it's when do you want to retire? When do you expect to live until? How much money do you need to? What are your current spending habits? What do you need to retire on? Or what are your expected expenses into retirement? And defining what all those parameters are, and then defining a portfolio to help reach that goal. It's also a function of, it's not a one portfolio till you stop investing. It's also, in our case, it's a evolving portfolio. So if you're into your 40s and you plan on retiring at 65, your time horizon typically is very long. So we'll give you a very aggressive growth portfolio. But once you get into your 55s, we now have to skew your risk down, recognizing that over a period of time, you'll want to retire and it'll be more about income and preserving your capital. So we have we're able to through our algorithms, define a portfolio that evolves over time to ensure that your capital is protected into retirement, and then allowing you where it's moving more from growth to income, making sure you have capital to retire on, and then in addition to that, have enough capital to live to have until you die. So we have all those tools available to us that we use for assessing longevity risk, and we help build a portfolio. We first define the goal, and then we're able to define the portfolio from that.
Thank you, Nauvzer. And John, yes, go ahead.
So this may be already done with all the tools that you have, but a recent requirement in the United States by the government is that defined contribution plans provide a tool for participants which indicates with the amount that they have saved and their age, what is the projected amount they would have on an annuitized basis of retirement. And so it helps workers assess whether they have saved enough.
And John, that does exist in the group retirement space. So that's been around for some time. There are retirement income projection calculators that have just been simplified, and now you can actually log in, and based on the data the employer provides to their record keeper, you can actually just see the age. So it'll just be right in front of you, like age 64 or 71. So we definitely have it in the group retirement space.
Yeah, and we also do have those tools available in the robo-advice space as well.
Thank you all. And John, you, I kind of want to follow up what you mentioned just now, and is kind of related to my next question. You mentioned in your work before that trust is a big issue for pensions, and just want to get your thoughts on in what way can the emerging pension technology kind of help or establish this trust or strengthen that trust. And the technology here could be, beyond the robo-advisor we're talking here, maybe just AI and machine learning in general. What's your thoughts on that?
So trust is an important issue in pensions, but it varies considerably across countries. And in some countries, there's very little trust in financial markets. There's little trust in the government policies. There's a little trust in the fairness of the pension providers. I mean, it's a completely different situation than you have in Canada, where I'm sure there's a high level of trust in all of those issues. But still, even then, the issue of trust comes in when people are seeking advice. Do you trust a human financial advisor? Is that person really providing advice that is solely in your interest? They're, of course, trying to make money for themselves also. And how does that enter into the advice that you get? And on the other hand, do you trust a computer algorithm, which is not a person? It's a fintech tool. And so I think that the trust enters in even in countries like Canada, certainly in the issue of advice. Who do you trust to provide advice to you?
Jillian, Nauvzer, any thoughts on that?
Yeah, so Mercer actually did a global, like a Canadian-wide survey on this. We also were curious about trust. And surprisingly, a very high percentage, it was over 80% of Canadians are totally fine with the self-service model until retirement. And then at that point, relying solely on technology is like about over 80% said that is not something that they would trust, right? So it feels like the way we would interpret that is that using robo-advice for personal savings that are more short-term related, or something like an RESP, or something that you can self-service quite easily as one component of your broader savings portfolio, is widely acceptable. But as people get into more complex, decisions like I have multiple pensions, I have multiple sources of savings. In fact, the average Canadian would have 8 different sources of savings when they retire. That's when the trust breaks down, and all of a sudden, and it's not clear to us if it's a situation where it's too confusing for that employee to put all of their inputs in, and the algorithm or kind of the interface that they're using is not user friendly or can accommodate them, or if it's just they want to look someone in the eye and make sure that they are taking care of their future. It might be a combination of both. But I think to us, it's very interesting that trust definitely kind of dissipates as people accrue more money.
Yeah, the only thing I would add there is I think when we talk about trust, we have to preface it with age demographics. I think a younger age demographic is more open and willing to trust a digital platform, whereas maybe as Jillian said, as you get closer to retirement or in that age demographic, they prefer to have more human interaction, which I think it makes sense based on, if we look at where the assets, a majority of Canadian assets are, they're at the older demographic versus the younger, and that's why we haven't seen as much adoption into robo-advice as perhaps we all thought we would see 7 years ago. Not to say it's not coming, but it's probably slower than many had expected. Now, what's interesting is that as we go through this big transition of assets from the baby boomers to down to the next generation, that generation is more open to and trusting of technology. So what's interesting is what we'll see happen 10, 15 years down the road with traditional advice. I think we'll see a higher adoption or a higher penetration of assets into the robo-advice space.
Thank you, Nauvzer. I think that's a very interesting kind of lead into our next and perhaps the last topic we want to discuss before we go to the Q&A session is let's probably just explore a bit further the relationship between the traditional financial advisor, the real human being, and the robo-advisor. So looking forward, some people say there's a big war between AI versus human being, and some people say no, AI is not going to fully take over. There's still reasons why a human financial advisor should exist, and some values they can provide that cannot be replaced by AI or robo-advisor. So I want to get all your insights on this. How do you see human financial advisors and robo-advisors live in harmony in future? Because it sounds like in the near future, robots are not going to replace human financial advisor completely, at least. Maybe we'll start with Nauvzer. Do you mind?
Yeah. I mean, so I think what we're seeing more and more of is where robo-advice and traditional advice are sort of coming together. In let's call it a hybrid model, where traditional advisors are using see the technology as a way to advance their relationship with their clients. So I think there is a way to coexist between traditional advisors and robo-advisors. There's also a way to share the assets amongst traditional advisors and robo-advisors. So I think we will see a way where both coexist. And as for AI, I think that's another opportunity where I don't think it's specific to robo-advice or traditional advice. It's just once we're able to evaluate the information that's in front of us, we're already seeing with the big banks as well, where they're trying to analyze data to look for patterns amongst a spectrum of client bases. And that's something that we'll see more and more of, both on the traditional advice side and on the robo-advice side. Robo-advice may be quicker, just given the nature of the business and the technology that's available to use that to provide a better spectrum of investment advice. But I think over time, we'll also see traditional advisors using that to improve their relationship or to foster a stronger connection with their clients.
Thanks, Nauvzer. We have probably 2 minutes for John and Jillian to comment on this question. I still want to leave a bit more time for the Q&A. John, any thoughts and comment on, the robo-advisors versus human financial advisors?
Okay, it's a big question, but I will limit my comments to fees. And it is clear that robo-advisors have a substantial advantage in terms of the fees that they charge. And they also tend to use lower fee index funds rather than actively managed funds. And there have been some studies, it's a new area, but there's some evidence that robo-advisors actually do better than human advisors. And it's not because they're smarter and they have, better investment choices. It's because their fees are lower. That the difference in fees is substantial enough so that people who use robo-advisors come out ahead in terms of the rates of return that they receive. And I think my last comment is that will probably put pressure on human advisors' fees, which may come down because of that.
Thanks, John. That's a great perspective. To be honest, I taking advantage of this low fee structure when I'm using Wealthsimple, for example. Back to you, Jillian. Last but not least.
Yeah, no, I agree with everything that's been said. I mean, I think we still have some pretty big gaps that the robo-advisors that haven't figured out how to meet. And the biggest one being, if I have saved a large sum of money and I'm now ready to turn that into income, how do I line up my income streams to my lifestyle? And that until we can fix that and we can make that as automated as possible and regulate it, because that's going to be a very difficult thing to do. I think human interaction will always be necessary for a person to, at some point in their savings journey.
I guess that's a big relief for our human financial advisors in this seminar today. Maybe we only have time for one question. There's a question from the audience asking, can you talk about the opportunities and challenges of Canadian robo-advisors? I think Nauvzer and Jillian, John, you all mentioned, Canada is a bit behind. We kind of start on a high note, although we're quite behind, say, compared to our southern neighbors. So opportunities and challenges in a few quick sentences. Anyone can go ahead if you, Nauvzer,
Yeah. So okay. So I'll start with the challenge first. I will start with the negative because I have something to look forward to after that. So we'll start with the challenge for Canadian robo-advisors. I would say the challenge there is the stigma of, being only suitable for a small subset of clients that perhaps don't have a lot of assets or a lot of investments. And I think that's not always the case. As I mentioned, referring to my own situation, I invest all of my money through obviously I'm biased, but my own company, because I feel like we do have portfolios that allow us to invest at any net worth level. So I think there's stigmas there. The other challenge is obviously, as we talked about, which is trust. How do you show those clients that have assets that this is a trustworthy alternative to human advice? And there are those biases that people have when it comes to managing their money. They would rather they see someone face to face versus dealing with a computer, even though it's at sometimes it's at the detriment of their own investment portfolio. But so that trust is an issue. Now, what's the opportunity? I think the opportunity, as I mentioned, is as we see the transitioning of assets and more adoption with a younger demographic. I think, John, you mentioned Wealthsimple's average age is in the 30s. I think. So when we do have that transition of assets, you will see more and more people, more and more assets at a faster pace migrating towards a digital advisor or robo-advisor versus what we're seeing right now. And the last thing is that we have access to a lot of tools to help on the planning side on establishing the trajectory of their assets, things like that, that clients can use to see the value or see their assets grow over time, which perhaps people don't always realize are available to them.
Thank you, Nauvzer.
Sorry.
Maybe we'll give Jillian or John the opportunity to comment on this last one. We have about a minute left. Any final thoughts you would like to share?
I'm going to throw in the financial wellness piece of this because I think it's a really important part. Based on our research and data, we think that the majority of Canadians are stuck in just trying to get control over their day-to-day expenses or trying to figure out how to save for an emergency. They aren't yet at the place where they feel confident or comfortable enough with their personal situation to start setting goals and trying to meet those goals because their goal is to get through the day or the month. And so on the flip side, this, I think we, can all agree that robo-advice plays a very important part in the journey of financial wellness in getting that confidence and control back. But I think that the gap is that where does this fit in that journey, right? People don't have the financial literacy potentially to be able to use these tools the way that they were intended to be used. In fact, some of my colleagues in the UK had shared with me that, Robo-Advisors eventually had to try and appeal to public policy changes to be able to upload what would be the Canadian equivalent of a Canada Revenue Agency tax return, because people weren't even submitting the right information. And, you only get a financial plan based on the information you submit. And so I do think from a financial wellness and overall literacy perspective, we have to move cautiously, but it is a good engagement tool.
Thank you, Jillian. And once again, thank you, John, Jillian, Nauvzer, for sharing your insights and experience and spending the last an hour with us. And thank you all for coming, and hope you enjoyed today's discussion. And thank you again for coming. Stay well and stay safe.
Thank you, everyone.
Thank you, everyone.